Let's get to the big story for the day, which is, of course, the taxation changes with regards to debt mutual funds. And Radhika Gupta is now joining us. She's Managing Director and CEO at Edelweiss Asset Management Company. Somebody who, of course, runs a lot of debt money and is looking at this very closely. Radhika, good to have you with us here. Good morning. This does hurt the entire category immensely, doesn't it? Tell us what do you make of what has been done? The implications, and why do you think this has been done? Go on.
Good morning, Prashant. So I think this comes as a surprise, and it has a very adverse effect, not only on debt mutual funds, but also on some other categories of mutual funds, gold mutual funds, international mutual funds, fund of funds. So the impact is not small, and it's wide-ranging. I would make 2 points here. See, I think it's an unfortunate step, and I think this is a proposed amendment in the finance bill that's going to be passed, and I really hope it's rethought because, as you said, we run large bond portfolios, and debt mutual funds have been an important product for the Indian consumer because finally we are a country of savers and financialization is just happening. Now, a program like Bharat Bond, which is a Ministry of Finance sponsored program, has seen tremendous success, has hit 55,000 crores. In the last 3 years, target maturity funds are just growing. In fact, debt mutual funds have been able to channel significant amounts of 10-year plus money into the bond market. And I think all of this will be very adversely affected with a move like this. The second thing is, it is important to think about the second-order impacts of moves like this. I mean, India is finally a country that needs significant borrowing because of infra spend. Bond market liquidity and development has been a concern regulators and governments have had. And, to be frank, mutual funds are the significant institutional investors that are not hold to maturity because all other bond investors are hold to maturity. So I think you also have long-term implications on bond market liquidity and a lot of borrowing then coming back to banks, which is not good. So, it's not a good move. I'm surprised why it's been done. And it's also come a little bit out of the blue.
Sure. Radhika, good morning. Surabhi here. I just want to dial back a little bit and go back to that definition, which is, of course, causing, the worry and the jitter. For the benefit of viewers, I mean, we're talking about larger issues which are very important, but for the benefit of viewers who are trying to understand what this potential change could be, could you just go over this? Because now what they're saying is that any fund where the equity holding is less than 35% will perhaps lose the indexation benefit. So that really pretty much applies to the entire debt category, to perhaps to foreign funds as well. Could you just go over the definitions?
It's actually a more tight definition than that. So it's funds with less than 35% in domestic equities, not even domestic funds. So in my understanding, Surabhi, it applies to all debt funds. It applies to gold funds and gold ETFs. It applies to international fund of funds and international funds because they are not domestic securities. It even, funnily enough, applies to fund of funds which are investing in domestic Indian equities because it's actually a fund of fund product. The mutual fund is holding other mutual funds. So outside of plain vanilla equity and hybrid funds, which have more than 65% or 35% equity, it pretty much applies to all mutual fund categories on a prospective basis, not retrospective.
So what does this mean for incremental flows coming into debt funds? Do they dry up? Where else do they go? I mean, I was just looking at some numbers. We got some data as well. 40% of the current AAUM is in debt funds, non-equity that is.
Yes.
What happens from here, Radhika?
I expect if this were to be passed, the money that comes into debt funds over 3 years, where you enjoyed the tax advantage, may look at other alternatives. It could be listed bonds. It could be FDs again. And it's a question of how many options there are and who migrates to what options and what absolute yields are. Money under 3 years never enjoyed the tax advantage. So I think their debt mutual funds, liquid funds will still be used for cash management. It's that over 3 year money, that will be impacted.
And it is that money that was really mobilized through big offerings when retail started getting into debt mutual funds, right, Radhika? Because, whether it's Bharat Bond, which you folks started at Edelweiss, or even some of the other funds, the whole attractiveness of debt, mutual funds versus FDs, was the fact that indexation made them a lot more lucrative. Isn't that right?
Absolutely. I mean, look, the whole target maturity fund category after liquid was the biggest debt fund category after Bharat Bond. And the whole story was you're probably 1.5% better than FD on a post-tax or traditional instruments on a post-tax basis. And I really think that movement was just beginning to kick off, over the last 3 years. So, as I said, I am hoping this will be revisited, because we still have some time.
Right. I think although the bill is up for passing today, Radhika, right?
Yes.
The amended one.
That's good one, yeah.
We'll see. Just one thing, Radhika, from a asset management company perspective, if this were to go through and this category sees outflows, it's negative for asset management companies broadly. But I'm just trying to understand what's the hit in terms of income for AMCs, because lots of them are listed as well. Is it going to be significant?
I don't think you'll have immediate outflows because remember, existing AUM is grandfathered. I think the questions are large. I don't expect existing AUM to go out. In fact, I think people will retain existing AUM because it has tax benefits, right?
Correct.
I think it's new growth in fixed income that will be impacted.
Yeah, no, absolutely. I think that's a good point. Only after 1st of April, so it's for fresh decisions this does come in. Radhika, we'll keep touching base with you for more nuance on the story as the day goes by. But this is the big one, which Radhika is also explaining to us, which has happened, the big change which has happened. We'll take a very quick break here, the first on the program. We have back stocks to watch out for with our team in just a bit.